My name is SB2.ASX, and I'm going to talk about investing in the technology sector in 2023. After a significant sell-off in the technology sector over the past 18 months and sentiment towards the sector at all-time lows, today we discuss the relevant factors when considering whether now is the time to consider weighting back into this much maligned sector. As a result of the negative sentiment being heaped on the sector, it feels that the market is throwing all technology companies in the same basket, whereas the reality is there's a huge disparity of fundamental characteristics in this basket of stocks, which is creating some very interesting opportunities. While there are multiple contributing factors to the decrease in valuations in the technology sector, the cash rate has been a significant contributor. The cash rate, or more commonly referred to as interest rates, is a key determinant in the cost of capital for technology companies, which historically have been quite capital consumptive on their growth journeys. It has been well documented that interest rates have been used as a key tool for combating global inflation. As can be seen in the chart above, there has been a clear inverse relationship between the cash rate and ASX-listed technology sector companies over the past 10 years. It appears that global inflation has now reached its peak and is slowly coming under control, and the increases in the cash rate should soon be coming to an end, and there's even talk of lowering the cash rate in the second half of 2023. This is potentially an interesting tipping point for valuations in the tech sector, which could be poised for, we think, quite a positive re-rating in the second half. Prior to 2021, technology companies were incentivized and rewarded for pursuing growth at all costs. This party abruptly came to an end during the December quarter of 2021, and technology companies were forced to rein in costs and focus on more sustainable growth. 18 months on, many tech companies have now reset their cost base and refined business models for sustainable growth. A large number of these companies are now in the process of swinging from loss-making companies to cash-profitable businesses. Many companies have also strengthened their balance sheet in light of less certain outlook for access to capital. The net effect of these factors is that there is an increasing number of technology companies that have strengthened their relative positions and have never looked better, exactly at a time when valuations are at cyclical lows and no one is looking. The devil is in the detail when investing in technology companies, and this has been never more relevant. We have been trawling through the beaten up names in the ASX technology sector and are encouraged by the risk-worse reward proposition being presented by a handful of specific companies. One such example is RPM Global. RPM Global is a 350 mil market cap ASX-listed global mining software business that delivers software solutions to major resource companies globally. From a scale perspective, they're on track to deliver $100 million of revenue in FY23 and $8 million of profit after tax. Revenues are forecast to continue to grow by 20% and EBITDA margins to increase to 25% as the operating leverage kicks in, potentially taking profit after tax to greater than $23 million in FY24. RPM Global has a strong balance sheet of $40 million plus of cash, no debt, and this cash balance is growing. These metrics put the business on a 10 times EBITDA multiple and 15 times PE ratio, which is in line with the broader market multiples of general industrials companies, whereas quality technology companies such as RPM Global can and should command a significantly higher premium as a result of the rate of growth, depth of intellectual property, and quality of our earnings, in our opinion. Another example of such a company is AI Media, which is a great example of an ASX-listed small-cap company that is set to benefit from the latest wave of tech disruption. It's well positioned to benefit from the fast-emerging improvements in artificial intelligence, or AI, that especially we've seen recently with the rise of prominence of ChatGPT. Ironically, many see AI Media at risk due to the emergence of ChatGPT, though we very much see it as a beneficiary. AI Media is a global leader in the provisioning of high-quality live and recorded captioning, transcription, and translation services. They're deploying the latest AI to deliver this solution with its global, scalable, and secure iCap cloud platform. iCap is the largest closed captioning and subtitle delivery network in the world and is owned by AI Media. Customers include major broadcasting companies, along with corporates and government for internal communications platforms. Examples include Foxtel, Channel 7, recently announced Google, as well as various government clients around the world. AI Media is on track to deliver $60 million of revenue in FY23 and an operating cash profit. The headline revenue growth rate is masked by customers transitioning to the lower cost but higher margin product. As a result, the quality of earnings is improving, along with the positive operating leverage in the business kicking in. AI Media enjoys a strong balance sheet and is generating cash. The global growth opportunity is significant for AI Media, and a business of this nature would typically trade on a 3 to 5 times revenue multiple. At the current share price, which is down more than 70% from its highs, AI Media trades on a revenue multiple of less than 1 times. In conclusion, while it may be considered a contrarian view, a number of factors are leading the team at Salter Brothers to suggest that, at least at a minimum, the time to start increasing exposure to the technology sector is fast approaching. Thank you very much for listening, and we look forward to sharing further insights and updates from SB2 in the coming months. Thanks.